Well, I can't watch.
Everyone's on the edge of their seats, wondering what to expect from the markets in 2022. Well, wait no longer because I'm going to show you. Hi, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. If you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. Everybody wants to know, what does a Chief Trend Strategist do? Well, part of my job is identifying and finding these repeating patterns in the markets and stocks and exploiting them to the benefit of investors. So that's what we're going to talk about today.
You have my undivided attention.
2021 is in the bag. And for everybody that's pondering what will happen in the market over the next 12 months, there's actually this cycle that we can turn to for guidance, the US presidential cycle. Now, I have successfully followed this trend in times of crisis and in times of plenty. And believe me, you are going to be surprised at how accurate it is. Okay, so this is what I used to predict that the S&P 500 would increase at 19% in 2017, no matter who won the election, which it did. It's what I used to predict the Great Correction of 2018, which we got. It's what I used to forecast at least a 17% return in 2019, which we got. It's what I turned to warn investors that 2020 was going to be a turbulent year for the markets, which we saw obviously in a variety of ways. Hold on! And it's also what I used to predict that the markets would gain more than 16% in 2021, which we saw. Now, I've been able to do that because, instead of these really long historic trends, I created a streamlined modern version of the US presidential cycle. Okay, this is a 4-year cycle that has 2 monster years and 2 years of caution. Now, traditionally, the view posed by trend trading icons like Hirsch is that the 3rd year of a presidential term is the strongest, followed by the 4th, then the 2nd, then the 1st. Well, even though I respect those guys, I do have to politely disagree.
It's false. No way. Not this time.
Because my data shows something different. And that's because, again, I'm looking at this modern era. As we've seen over the last 9 presidential terms, the Dow Jones Industrial Average's best years by far have been the 1st and the 3rd years, right? So there were in agreement with the traditionalists on those 3rd years, but the 1st year and the 2nd year and the 4th year, you can see, is actually completely different. Now, using that modern model of mine, we see that in that 1st year of a new presidential term, the Dow is averaging a 16.06% gain. And in the 3rd year, the blue chip index's average gain is even better at 17.22%, right? So these are just averages, right? So we can see that these are really big gains. Now, 2021 was the 1st year of the new presidential cycle, which we're in, and right on cue, the Dow gained almost 19%, right? Why does that happen? Why do we see that in this time? That's because there's a lot of optimism and momentum heading into that 1st year. For the most part, regardless of what's happening at the macro level, stocks are going to rally. We saw that last year, despite COVID, despite inflation, in spite of the fact that there were these supply chain issues. The only 2 recent underperformers in that 1st year of the cycle were all the way back in 2001 and 2005. But going back to 1989, for the most part, investors are guaranteed basically a double-digit gain in the 1st year of this new presidential cycle. That's great. Everybody had a fantastic 2021. Now we have to prepare for the 2nd year, which is a completely different story, unfortunately.
No!
What happens in the 2nd year, in my analysis, is basically the honeymoon is over, so to speak.
No excuse or anything?
All those promises from Congress and the White House, all those bills that were sure to be passed to make all this change, they don't really come to fruition.
And I'm gonna stay right here
and fight for this lost cause.
On top of that, in that second year, you have midterm elections, and these have become, more and more partisan. One side is desperate to get something passed to warrant, some sort of re-election. The other side wants to prevent that from happening. In turn, everyone suffers.
Somebody will listen to me. Somebody will.
And the market struggle, averaging just a little bit more than a 3% gain. The only year that's worse than the third year is election years, because election years are so contested and no one wants the other side to win.
I agree with everything he just said.
They've been really, really tight, and the markets hate all of that uncertainty. So again, we're in this second year. This is a midterm election year. There's all this uncertainty. We know that traditionally the party that's in the White House, they're going to lose the most seats in Congress in this midterm, and then, that's going to shuffle their entire agenda. So in the modern era, the Dow has finished the second year of this cycle in negative territory in 1990, 2002, and 2018, and posted single-digit returns in 1994 and 2014, right? So there's a lot of years of struggle. The years that actually were solid gainers were 1998, 2006, and 2010. So with all of that in mind, I would not be looking for stocks to post another double-digit return in 2022. This is a year for tempered expectations, particularly in light of inflation, which I talked about earlier, the fact that the Federal Reserve is raising rates and rapidly scaling back its tapering, not to mention we're entering our third year of a global pandemic. There's probably more variants on the horizon, or whatever else is going to happen in that sort of storyline.
Wow!
That's a lot of headwinds with these midterm elections taking place. So history tells us the second year of the US presidential cycle is really a bummer for stocks. And that's okay though, because there are plenty of opportunities for short-term gains in sideways or volatile markets. In fact, those type of years have been some of my best years as an investor.
Is it possible this story is true? Yes, it is. You're right. It's fact. Yes.
On top of that, these are the years where, you kind of want to make sure that you have safe havens in your portfolio, such as gold or other precious metals, to kind of help ease some of that sort of volatility. Well, I'm Matthew Carr, Chief Trend Strategist at the Action Club. Thanks for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's to high returns in the new year.